Just keep it open.
Sure.
Up to you. Yep. All right, we are live. Yeah, so I've also asked if the panelists can keep an eye on the chat box as well.
Absolutely.
Yeah, depending on time, I might even actually able to let people actually speak on the ask the questions, but we'll see how that goes. Let me also try this called live on Facebook. Never done it. Let's see how that works. Share your timeline.
Hey,
Yeah.
Henry, do you want people to start asking questions in the Q&A or the chat box?
Oh, in the Q&A. Thanks for reminding me of that.
Yeah, I can monitor that too.
Yeah, so if you have a question, please put it on the Q&A box. All right. We'll be starting just a moment. Just hang tight. For me, I have some coffee, but maybe some of you have red wine or something. Shut up for the evening. And I'm waiting for the Facebooks to go live. My first time playing around with this technology. We'll see how well it goes, but let's give it us another minute before we start. Okay. All right, it is 6 p.m., so why don't we go ahead and get going? We have tons and tons of material we want to go over today. Well, welcome everybody for joining us for our Coast-to-Coast Multifamily U Meetup, hosted by graduates from the Multifamily University Bootcamp. And we have members from Seattle, San Jose, Bellevue, New York, San Francisco, Tampa, Los Angeles, lots of members from different parts in the U.S. today to talk about what's the latest news and kind of webinars that we heard the past week. There were, wow, so many of them. Can't even keep track, and I probably missed a few good ones. And so I can't do it all on my own. Even I'm like listening to webinars. I have recruited all our friends and panelists to collect information and try to distill and summarize what's crucial, what's important, and to share with everybody. So our meetup group, it's just for anyone who's interested in learning about real estate, what's happening, especially in today's world, which is unprecedented. A lot of news might come up and might have 5 to 10 days of shelf life, right? So there's all these new regulations and that are coming out as well. So hopefully we bring in some value together by presenting this information. So without further ado, we'll keep going. And also, kind of logistic-wise, if you have any question, please put it in the Q&A box, and panelists and we'll be responding to that as well. And also, this webinar will be recorded, so we will be sending those who register and also who get attended or not will get a recording of this video. All right, so we'll keep going. So just give a plug to the Multifamily University organization. It was founded by Neil Bawa, and he's a great speaker and kind of influential thought leader. That's where I and among a few of other panelists have learned how to learn underwriting, how to do deals, how to raise capital and all the many good things, especially was how to identify the best demographics, which I like the most, and has lots of tools to share. So if anyone wants to get really knee deep into how to do underwriting, I would strongly recommend going to the website multifamilyu.com. And so And that's also where I met a lot of other panelists and made friends, and we were actually doing some deals together. So also, they have already done 2 webinars presenting great information, and they'll be doing the 3rd one coming this Thursday. So we'll have more information on that at the end of the presentation. All right, and so that I want to just maybe start introducing the panelists, and I have them each give a little brief bio, since we have tons and tons of material, so we'll try to keep it short. So I'm Henry Yun. I'm the one in top I'm in Seattle. I have 3 kiddos, and I've been investing in single family, and I was looking for great passive income, and it's been looking to do multifamily, JV, and syndication route. So that I will maybe go clockwise. We go to Yan.
Hello, my name is Yan. I'm from New York, New Jersey. I work for a hedge fund, and I want to apply my quantitative skills to analyze multifamily deals. Thanks.
All right, James, you want to go?
Yeah, hey everybody, this is James coming from sunny California. I've been in real estate for about 3 years with a heavy focus on syndication acquisitions for about the last 9 months with a few partners of mine, and just really interesting times now just to get involved in all the educational content and really delivering all that to you. And it's an interesting time because we're all together on this journey, and we're excited to share this all with you. So I know I was longer, but I'm just really excited for this presentation. So
Awesome, James. Hey, Peter, go next.
Okay, so Peter Pomeroy, San Francisco. Kind of have a long career in real estate and recently been focused on multifamily syndications, learning as much as I can, and looking for deals. And then all of a sudden, COVID happened.
Yeah. All right, Vijay.
Hi, my name is Vijay Kim. I'm from Los Angeles, and I've been interested in I've been a money lender for local rehabbers. But for the past year or so, I've been focused on multifamily, and it's a fascinating field, and I'm learning a lot. So I'm glad everybody on this webinar is here, so we can go on to this learning journey all together.
Awesome. Last but not least, Vivek. Oh, we also got Bowick too, but go Vivek.
Hey, Henry. Hi, everyone. My name is Vivek Arza. I'm from San Jose, California. I live here with my beautiful wife and 5-month-old daughter. My passion for investing in finance has led me to different investments and also to real estate. I personally invest in a portfolio of rental properties out of state and looking to scale more. I'm really looking forward to the information that this group has to share, and also share it with the community of investors.
Thanks. Hey, Bowick.
Oh, hi. Good evening, everyone. So, yeah, so I'm a licensed investor in title industry for 18 years to learn with all of you tonight.
Awesome. I don't think Chuck is able to make it tonight, but I think we'll keep going. So here's the contact info for those of you who may not be able to sit through the entire presentation. There's an way for you guys to find us, and I want to chat about any of the materials we present today. I can take a quick screenshot or snap of this contact list. All right, without further ado. All right, so agenda, we basically are going to cover a number of presentations. So that's this is how they are in order. But I think in general, we want to answer some key questions, such as whether it's what is the current sentiment for investing in commercial properties, multifamily, kind of what the expert opinions are on different things, such as what they see in prices, how they're doing in rent collection, also what kind of assistance the government is providing to help either real estate owners or just people on the street. So, all right, so we'll just keep going through it. Go ahead, Vivek, and Peter, if you guys want to take on this one.
Yeah, thanks, Henry, for the introduction. Hope everyone's doing fine and their families are safe and healthy. We are definitely going through some unprecedented times all over the world. Here in the United States, the economy has come to a virtual standstill. due to shelter-in-place guidelines, and I think most states have it now. I'd like to start off with looking at the state of the economy. Uh, One obvious indicator that we see is job losses. In the last 2 weeks, over 10 million Americans have been out of work or have been had reduced hours. Just look at this chart. I've never seen this in history, and this has been more sudden and more massive than any other period. Some industries have definitely seen the impact more than others. Service-based economy like hotels, airlines, casinos, bars, you name it, any kind of non-essential services have really taken a hit. The less the number of jobs there are, the lesser the spending. And since about 2/3 of the economy is driven by consumption, GDP decline is definitely going to follow. Goldman Sachs, one of the investment firms, predicts a 9% contraction in GDP in Q1, followed by an incredible 34% decline in Q2. This Q2 will be the worst economic period in post-war US history.
Yep. Yeah, we hear the word unprecedented a lot of times in the news. Definitely, we're in that period.
Yeah, that's right. And I think the job losses are just staggering.
Yeah. Okay.
Next slide, please. Here you can see what, sorry, here you can see the stock market roller coaster happening through the month of March. This really reflects the two things investors dislike the most: fear and uncertainty. If you're uncertain about what's going to happen in the future, you have a lot of fear, and it just feeds like a vicious cycle. The last month and a half has been a roller coaster, and definitely not the fun kind. Just look at the chart. We've seen record single day losses followed by gains. In March 16th, you saw the second largest ever loss in a single day. And if you see on the right, you have March 24th, where you saw a significant gain. How is an investor actually trying to come to terms with wild swings like this? The S&P 500, the last I checked, was down about 10 or 20%. And what this causes is a lot of investors get stressed out and have very little time to react. You know what's worse? Many of them are dealing with situations regarding health of their families, and they really have no time to react. I think that's pretty much what's been the story for the entire month of March. We do see some recovery in the stock market this week, but who knows how long it's going to last. Peter, do you have any other inputs on how the stock market's been performing?
Well, I think that just adding to what you're saying and kind of leading into the next slide is investors can't think. They can't think when there's this much volatility, even if they're on the upside of that volatility, unless you're a professional, like Yan in the hedge fund business, and that's for business day in, day out. It's almost impossible to think as a kind of individual consumer investor. So why don't, if you go to the next slide, unless there's more you want to talk on that, Vivek. But what we're hearing and what was discussed in this podcast, the investor mindset wasn't a podcast, it was a video with panel discussion, is capital preservation. And now I've heard about capital preservation for 20 years, and now it's like taken on a new kind of a new meaning where it's not just one of the challenges, it's kind of like a problem, a specific problem that needs to be dealt with. Because most people don't like, keeping, all their net worth in cash. They want to do something with it. And, this crisis will pass. And then when it passes, they'll tiptoe back into various markets.
Right.
But, when you've been hurt, and you've lost net worth, what's first and foremost is capital preservation.
Absolutely.
Yeah. And then a lot of, something else we're hearing a lot on the webinars and podcasts is that people may have undiscovered, this new investing power as they're able to increase the loans that they get from their 401ks from $50,000 to $100,000. And while the total, if you're, fortunate and, the total value of your 401, well, unfortunate in the sense that your 401k has dropped, but fortunate that you're able to loan to a maximum of, of $100,000, you now all of a sudden have some dry powder to invest with. And, that creates an opportunity. And then of course the question is well, what should I be investing in? The third thing we're seeing with investors is alternative asset types. So obviously in real estate, there's office, industrial, retail, multifamily, and all of us came together by way of multifamily for a whole bunch of reasons. But there's mobile home parks and self-storage facilities and car washes that are provide good returns, but have historically been looked over. And then the fourth one is the real estate operator and investor alignment, and it really has to do with navigating storms. So it's no longer if the storm happens, or even kind of when if the storm happens, but it should be built into the calculus, into your equation, that a storm is going to happen, something's going to happen. A Katrina is going to happen. A school's, a terrible, event's going to happen at a school where, there's shootings, pandemics are going to happen. And, are you with an operator who will be able to navigate through that, thoughtfully?
Yeah, I think I get the sense of this. I mean, capital preservation is absolutely what investors are looking for right now. And I think the CARES Act provides a lot of benefits, both for investors and small businesses. We have a lot of slides coming from other panelists which discuss the CARES Act. But I think but what investors are looking for is alternative sort of investments and also preserving their capital.
Yeah. And oftentimes, it's where these places that seem like odd investments that are quite interesting. So that'll be exciting as those, and not that self-storage or mobile home parks are anything new, but as they emerge from kind of not the flavor of the month, year, even decade, and all of a sudden they become kind of popular, what's going to happen with demand for them and everything else that corresponds to that.
Absolutely. I think the next slide shows more about who's investing where currently. So
go ahead. Sorry.
No, go ahead, Peter.
Right. So I was just going to say, so the in terms of who's investing, so institutional money is kind of frozen. Maybe that's a little strong for some, but generally that's on target. And that has a lot to do with how those decisions are made. I mean, the people on this call are, while we may have kind of corporate or institutional backgrounds, our interest in real estate is very entrepreneurial. And with institutional money, it goes way up to like a pension company, and they're like, okay, our allocation just dropped, and then that goes all the way down. So those deals are on pause. As Vivek has written, the lending has become more restrictive, and they've got the billions of dollars in capital to pause. What's interesting is private equity and family offices and individual investors, three of them. And maybe by private equity, we haven't researched to see what tier of private equity. But I think if you were to safely assume that firms that may have $1 billion in assets, maybe even more, Yan might have more to speak on that. But they are, underwriting deals, they're looking at deals, they're looking for deals. They're doing that, more off market deals, which makes sense. Because if you're a seller of a property, you don't want to list a property for sale and then have it just be beaten around by the marketplace, right? So they're all going to be off market. And then one of the kind of key things that I heard is that these private equity firms in particular are getting their internal operations in order for strong acquisition growth.
Got it.
Yeah, so that's pretty exciting, I think.
I think they're positioning themselves for some strategic acquisitions later in the year, maybe.
Oh yeah. In terms of when did you say?
I was just saying they want to acquire something strategically once the economy improves.
Yes. Yeah. And I think later I think probably mentioned kind of various people's predictions on when that is, but absolutely. So that's a real good indicator that things will improve. So fear not. And then, two, what can we be doing as investors, in our big or small way to, take advantage of, the market and hopefully, buy something, improve it, and add some quality of life for people, and including ourselves.
Awesome. Yeah, I think the next slide really shows how the return risk profile for different asset classes sort of comes together. When you look at stocks, especially smaller cap companies, they've traditionally outperformed most investments, but they do come with a high degree of risk measured in terms of volatility and price standard deviations. Bonds are always low risk, low return, but we've seen as recently as last month that their yields have almost touched zero. And given that you take inflation into account, the return is really negative. Core commercial real estate, these are your apartments, offices, industrial, retail. They do have a good balance of low risk and high returns. Over a 20-year period, as you see in this chart, they've significantly been in a much better position compared to bonds or stocks. But there are some caveats to real estate. One is you just cannot sell your property in a day like you sell your stock. It is illiquid, and they generally are capital intensive. So that's something to keep in mind. Mm-hmm. Anything to add there, Peter?
Well, yeah, and I think that, this was a really fun, presentation to help put together. So yeah, real estate is illiquid, so it's got this like natural break to it that equities mm-hmm. market does not have. And maybe I'm just dense, but as I better understand the stimulus package, I'm understanding it as a 90 to 120 day bridge. And the purpose of that bridge is to keep individuals so they can pay their rent, and small businesses so they can continue to pay employees, etc. And by doing that, get us through a period of time that would be disastrous if all that went away, so that when real estate has like a moment to become liquid, it's not a disastrous moment, right?
Right.
The value of real estate right now or in 20 days is going to be a lot less than it is going to be in, say, 45 days. And then 45 days or so, or 90 days, that's when it actually could be liquid. So it's kind of an interesting way of looking at the stimulus act, or one of the benefits of it.
Right. And just to add to your point, I do understand that it's a cash flow problem that America is facing right now. I mean, you don't get paid for 2-3 months, but structurally, or the economy is still intact. It's just a cash flow problem that needs to be resolved. And I think both from a fiscal standpoint and from the Fed, we've seen a lot of support in terms of the stimulus packages that were put together.
Yeah, exciting. All right.
Go ahead, Henry.
Thanks, guys. Vijay, you want to talk about this?
Oh, which is it?
He might be on mute. Well, we can come back to Vijay when he's back online, I guess. We can. How about
Yeah,
James?
just ping me. He said he had some audio problems. He'll come back later.
Okay.
Sure. Yeah. So this is the second town hall with that Anna and Neil had held. It looks like they're going to be on this sort of a weekly schedule, given that the next one's in 2 days. So be on the lookout for that. But this town hall was with Andrew Sherman, who is a self-proclaimed business junkie who just reads like news. He just has a wealth of just various knowledge pieces, but he's also by trade an attorney. And to compliment him, it was Brandon Hall, who owns the real estate CPA firm, and he added the sort of CPA accountant hat and perspective of things, which was really quite timely given the stimulus package, which was a massive not only package, not only in terms of number of pages and complexity, but also just in the sheer number of dollars that were being provisioned through the various components of it. But one thing I wanted to open up with was the fact that we've had a lot, as Henry mentioned, we've had a lot of states that have instituted some varying degree of quarantine, stay-at-home order, lockdown, just like varying degrees of that. But April 1st is what as of now was the sort of first like litmus test of like, how is this how is the COVID and the quarantine as a result thereof, how is that actually impacting businesses? And it actually, and this 50% stat is from the Wall Street Journal, and granted, this small businesses is encompassing of the entire economy of small businesses, not just real estate. But 50% of small businesses were either not able, they either made no payments or partial payments for their April rent. Granted, this is taking into account that not everyone has applied for these stimulus programs. There is still money left. So, and I'll be getting into it shortly, but so it is more of a time thing. Everyone's kind of running to the gates to take advantage of these programs, and rightfully so, to protect employees, protect their operating law, all these things that we'll be talking about. So with the CARES Act specifically, it was I forgot the acronym. It's a really long acronym, but it includes a lot of provisions, and I won't be covering all of them. Yan is also going to be covering a few later, and as well as listing a few more resources, so I won't carry over that too much. But I just wanted to highlight a few things. That perhaps the one that's getting the headline news is the Payment Protection Program, which is to assist with people keeping people on the payroll so that they can maintain their jobs. And so that's a large portion of the stimulus package. And the actual total amount is $2 trillion, which is about just shy of 10% of the US GDP, which is actually a astronomical number. And that's as of 2019 GDP, which is about 21 trillion, I believe. So a few more, and when I was looking into this, there's actually quite a few beyond just the Payment Protection Program or the PPP. There's a lot of things that concern this like business operations, and which are quite favorable for certain types of real estate professionals. Real estate businesses, I should say, most of which apply to real estate professionals. But such as the net operating loss, which allows you to carry excess business losses. Brendan Hall went to a lot more detail, so I'm just kind of really covering the high level here, but it just instituted a 5-year carryback policy for net operating losses where you did not have that before as part of the 2017 Tax Cut and Jobs Act, which left that out, or did not have that, excuse me. Another one is the removal of a $500,000 cap if you're married for business losses. And I can give an example of that if you want, if you'd like me to, but just essentially removing this cap of losses so that more losses can be carried forward. So, and one of the really interesting ones I thought was it was actually correcting something that the 2017 TCGA attempted to correct. So it's more like a delayed kind of correction there. But it allowed qualified improvement property, which is by definition certain interior improvements made to non-residential real property. And it reduced the depreciation schedule, which allows for bonus depreciation, so people can do cost segregation and carry those losses forward. And it is a retroactive provision, so it is as if it was included in the original 2017 Tax Cut and Jobs Act. So, so that if you own like kind of those alternative investments that some of them that we're talking about, self-storage is a prime example. Retail is another great example. Office, things that don't actually have people living in them, these would be eligible for the qualified improvement property provision.
Now, one thing about the net operating loss carrying back 5 years, but that could be huge, right? If you buy an apartment with lots of depreciation losses, you can go back in your previous year and deduct some of that. Right?
Yeah, it's actually quite a generous provision for, the tax code is honestly, at least from what my understanding has always been at least more favorable to real estate investors and perhaps other businesses. So I think this is just another example of that, but also applies to other businesses as well.
Yeah.
But the government loves real estate.
That's right. We do have the chief of real estate in the White House.
Right. Yeah. So so on the next slide, they kind of trying to transition into, so that was more of like the nitty gritty logistics, like what is the CARES Act and like how's it applying to current events today with respect to the April 1st payments. But now like kind of moving forward, what can we do? And I think their main message was simply communication. And that's essentially what we're really trying to do now. We're trying to distill all of this information. You could have a full-time job last week, apparently, of just listening to all these webinars. And, there's quite a few things I want to look at myself this week. So we'll have some more to share for our next webinar. But it is my belief that if a lack of information leads to uncertainty, as Vivek was saying, and people don't like uncertainty. So that's our aim with this, is to deliver that information. So as whether you're an investor, a tenant, or a combination of these, it pays to have, this is a collective effort. So if you own a property, just as an example, talk to your lender, see what options they may have for, because no one has their head under a rock or in the sand. They know that COVID is impacting businesses. They know that rent collections may be an issue. They know that just businesses in general are struggling. And so we're all trying to like give a little bit so that we can all make it through this together. So have those conversations with your lender or bank regarding as far as agency loans, there's been a forbearance provisions for that. Or deferment, you can tack that on the like say the next 2 months payments onto the end, or there's a myriad of ways. And they did make it quite clear that this would be more or more easy rather if you have an existing relationship with your bank. If you're a first-time buyer and like you just closed on a property last year, it may not, I have 6 months worth of payments. It may be a little more difficult of a conversation to have to say, hey, can I actually change my payment schedule? Because you just don't have that history with them. But everything's worth a shot. So on the flip side of that, kind of going down the chain, so to speak, talking to your tenants, they need to similarly make rent payments to you. So it's kind of a similar conversation, being proactive in that and going to them and saying, hey, there's this situation, of course. So here's our kind of like, here are the options that, because to work out the rent payments, because you can't just stop not paying rent because we're a business. We need to take care of we need to pay for utilities. We need to pay for maintenance. So it's not just going to our pockets. So it's actually taking care and maintaining the property. So one of the unique options they suggested was using a tenant's deposit, which more or less could be first a month's last rent of their lease period, as a partial or full payment of their rent. So I thought that was a pretty clever way to doing it. That doesn't add any additional burden for the time being onto the tenant. And perhaps what I added, they didn't really talk about this too, but really talking to, if you're a syndicator, of course, talking to your investors, educating them, keep them on top of mind on what you're going through with your properties, how you're managing them, or what you're seeing in terms of other operators. So, and kind of moving forward, their predictions were due to kind of like what we talked about in the last webinar with the increase in lender reserves for agency loans, the fact that if you have an agency loan that there's a moratorium on evictions, there's going to be a significant decline in sales volume, not necessarily prices, but volume in the next 4 months, and would slowly, we'll see how slowly or how quickly, it's anyone's guess, but picking back up to normal levels, so to speak, in 2021. And but in terms of the price side of things, that really depends on how the next 90 days go. There's not much data yet on the April rents, but if everything goes smoothly with the, people are taking advantage of the CARES Act and the provision packages, and rents are still coming in, multifamily fundamentals are pretty solid as is. So if that rent stream is still coming in, then we're not going to see a decline in values. However, the unlikely scenario that June and July rents are impacted significantly, however significant that may be, then that's where we might see, and the fire sales, as they call them, the heavy discounts that everyone's always waiting for the recessions, but that Neil, in his expert opinion, doesn't believe that's going to be the case. So, and on a personal note, I believe we're in the thick of a lot of media pundits are seeing as the worst 2 weeks of the coronavirus, and the data is showing a slightly declining number of new cases in U.S., which I think is fantastic. And I think that's going to add a lot of optimism to just the consumer base in general, as well as investor bases, as well as operator bases. So moving forward, if all the quarantines are mentioned in place, then I think we won't see a decline in prices that Neil is also predicting. But it's still anyone's guess on how those 2 or 3 critical months might end up being in terms of rent collections.
Yeah, that's a good point.
James, I just want to add one comment that you mentioned that even though you are you don't have a long history with your lender, you can still apply for the forbearance program. So I bought my house last year, but I called my lender to figure out the detail about forbearance. So the only thing they mentioned is that show them the proof that your income is affected by COVID-19. Either you lose your job, or you reduce your working hours, or your tenant stop paying you or pay you less.
Right.
So anything that you can prove, then you can apply. So it doesn't matter how long you have relationship.
Yeah. And to your point, and that's great to hear. I think it's very case by case, and hopefully, every bank or lender is going to have already has a forbearance program, or is actively and very quickly working on one. So they expect people to take advantage of that and to have the conversation. So that was actually, to be quite honest, that was maybe something I somewhat disagreed or didn't think was too likely in terms of lenders from their opinion. But there's going to be cases where you're not going to be able to take advantage of that. But for the most part, I think it's fine to have those conversations, because you might end up being able to have an arrangement.
And just a point on, just a contribution on how tenants get affected. So you do have some advanced warning that rents are not going to come. You can communicate with your tenants if you're proactive. One of my tenants in one of the single family properties, she couldn't make a payment because she lost her job, but we worked out a plan, and then it's a win-win. They don't want to lose a roof over their heads. So that's something that you have some time to foresee. Just want to add that.
Yeah, and a lot of people are not at heart going to be bad apples.
Absolutely.
One thing to add that Neil said, if there is a bad actor or a bad apple that wants to take advantage of what you're trying to offer them, just kind of take them up on it. Have them prove, kind of what you said, Vivek, have them prove that they lost a job. Give them the phone number of their employer. Call them, hey, did you lay off this person? So kind of take them up on it. And if they are insincere, then they're going to back off. But most people, for the most part, are going to be willing to work with you, because they understand that you're feeling the hurt too, and we all are.
Well, right, and with the CARE Act and the extra bonus on the unemployment, that should help with the at least paying the rent, because that's what people pay is the food and shelter first, right?
Yeah, the unemployment benefits were extended in both time and amount. So that's definitely, I think everyone's very quite surprised and well pleased with how the just the government's responding to what this is, as opposed to like taking a lot longer in the last recession that we had.
Right. Yeah. Okay. So I think maybe we're gonna go back to Ujay. Are you back on?
Yes, I'm back on. Sorry, my internet was not doing well. But in case I get cut, one of the other panelists will continue where I leave up. So yeah, so this was actually before the Town Hall 2 meeting. Town Hall 1 meeting was last week. So at that time, they're kind of Neo and the panelists, they're kind of going over the mood of the whole situation. And I really like the way Neo kind of described it. He asked people to imagine this crisis as like a Category 6 hurricanes hitting every city all at once, and it's gonna go on for 6 months. But what that means, once the hurricane goes away, right? Once that's over, life will return to normalcy eventually. So the intrinsic value of these properties will not change. Okay, so people who can hold on to their properties, landlords, things will get better in the future. However, despite all that, there will be some defaults, and we may see bargains in Q3 because some landlords will need to sell the property. And some of the other interesting topics they talked about is the difference between Class A, B, and Class C and D. They feel like people in Class A and B, they tend to be professionals. They have jobs that allow people to work from home. So they're more flexible, and they have a little bit more steady income. And data from back in 2008 shows that people in Class A and B, it took them about 6 months before they actually decide to move out of these properties. So after 6 months, if people feel like this coronavirus situation is getting better, a lot of them may just decide to stay. And then, and we're kind of concerned about the people in Class C and D. Tend to be blue collar workers, and people in this class are the ones whose jobs will be, gone faster. Average household may have about $400 reserve cash. So it's good to see that the government is doing their best to really help out this group of people, because these people need the most help. And one other kind of interesting aside from real estate they talked about is they talk about the corporate debt bubble. So basically, right before this crisis, a lot of corporations having borrowing a lot of money because the interest rate was low, and it was just the environment was very good for borrowing money. So for example, like Netflix, right? When they want to make another drama or show, they sell the bonds and then get money financing from that. So their concern is that this debt bubble may burst, causing like a second punch to the current crisis that we're having. And I think this is one of the reasons why the Feds, they actually lowered the interest rate. I think part of the reason is to kind of help with this situation. So as investors, we should kind of just be wary of this possible second punch. Just pay attention to how that is going. And just one kind of like thing they talked about is like they found that the storage investment is doing well at the moment, and it's kind of somewhat insulated, kind of different from the publicly traded REITs. And one reason, just and I'm sure there's any thing to back it up by, is because like people don't want to travel right now. They don't have the time. They don't have the resources to just go there and then take out the things in the storage. So it may be somewhat insulated at the moment. And then going to tenant management, and from all the webinars I hear and as all the panelists discuss, there's like a general consensus that we gotta have empathy because everybody's in this together, especially for those tenants who need it, provide financial aid for specific situations, and they don't recommend dropping everybody's rent. Rather use our resources to help out those who really need. And then, other panelists will talk about it more about, landlords can apply for small business loans, and there'll be a forbearance programs available. So, yeah, so So there's a lot of resources available, and then the mood is that everybody's in this together.
Yeah, and to your point about the Class C, Class D being affected most, because I think a lot of their jobs are more in the service industry where, you know, they can't go to work, they can't teach yoga, they can't serve at the, you know, bar or anything like that. So I think it's very just impacted that class of tenants the most. It feels like, yeah. So.
Yeah, exactly. Yeah. Then all these aids from the government, the stimulus package is going to to the people who really need it. So I think overall they're trying to really be more fair with the whole situation.
Yeah, because I think the last time bailout only bail out the big corporations, so I think people are not happy with that.
Yeah.
So.
Well, you know, that might actually happen to these corporations if the debt bubble bursts, right? So that might actually create a lot of the same sentiment that they had back in the days. So we'll see how that goes on.
All right, thanks. Okay, I'm gonna go to the next one. So, going, Peter.
So Marcus, so these are just the findings and some screenshots of the Marcus webinar that took place this last week, and I was trying to think of like the essence 3 findings that were kind of stated over and over. And the first is that there's this kind of the dynamic is that there's this massive economic pullback that's hitting an otherwise sound and solid economy. The real estate fundamentals, I mean, we complain about this, that, and the other, not finding a value add apartment building that's not overbid, but you know, the economy is good, real estate fundamentals are generally good, and capital markets are generally good. And which is quite a bit different than the recession in 2008, which we'll talk about in a minute. And then, you know, obviously everybody is struggling to really assess the depth and length of, this economic impact and recession. We'll talk a little bit more about that in a minute. Our ability to, we've heard this repeatedly, to manage the healthcare component, that is the spread of the virus, will determine the length and severity of the economic downturn. So we'll go to the next one. All right, so don't worry, we're not going to go through this but what I want you to focus on, we're going to compare 2008 to 2020 and basically look at the 2 yellow lines. The first line indicates when the Fed started in 2008, started to make some rate cuts. And then the second line is when they did the Recovery and Reinvestment Act, that $831 billion. And so that was 13 months. So over a 13-month period, plus or minus, they did 13 distinct actions, which is approximately 1.7 trillion in legislative and Fed stimulus. So by comparison, if you go to the next slide, this shows what has happened now. It's a little bit, kind of tricky and even sensitive to say when the start of this was, right? And we're not going to get into like a whole political thing. But I went through some various newspapers' timelines, and basically I'm using a period of time when the Treasury Secretary was basically battling it out as to, what to do as it related to the economy. And then I think I maybe subtracted a month. So basically, long story short is, in about a 2-month period, plus or minus, we were able to pass a $2.2 trillion stimulus act. And you can, and it's kind of fun to look at the details, but if you just are looking on the right, you'll see that, $500 billion is going to large corporations, and there's been lots of debate and concern that they're just going to use that to buy back their discounted stock. But there's 377 that goes to small businesses. And by the way, that's defined as 500 and fewer employees. So it's not just, ice cream parlors and such. And then 630 billion to individuals. So it's weighted, if you take the 377 and the 630, it's weighted, I think, more towards the individual. and then of course 500 billion towards public health. And that is just looking at that one piece of fiscal stimulus. And there's been all sorts of other acts and so forth, and rate cuts and so forth that have taken place. So, you know, the idea, and it's I don't know that I necessarily buy, or that anybody's necessarily like, you know, pounding the fist that it you know 2008 and 2020 are identical, you know, and you know, by not spending bits of money over a longer period of time, we will, you know, avert disaster. But it's certainly two different acts, and you know, it's good to see as best we can, kind of in a side-by-side comparison. All right, so let's go to the next one. Oh yeah, let me pull this up here on my side. So okay, so again, we're comparing 2008 and 2020. And this speaks a little bit, I think, to what James may have been talking about. There were a couple of points he said that kind of, anyway, whatever. So, or maybe it was Wujay. But anyway, just in terms of bank reserves, you know, cash on hand, you know, you know, this gets at the kind of the nature of this slide. Is in 2008 and 2009, you know, our ship was not as solid as it is now. And so that's good in the sense that it should help us weather this storm. But then again, you know, we've not ever had a pandemic before, and so therefore we have no, like, you know, point of reference. But some key things here, that the banks have much more cash on hand. Corporate profits were 1.7 plus or minus in 2007, and around 2.12 trillion today. This is what I was thinking of with Wujay. So we had in 2007, there was about, corporate cash was about 300 billion, and now it's about 1.2 trillion. But it would be interesting to see how much debt they had on hand as compared. And then moving on, then February, as we moved into February 1, our unemployment was 3.5. I forget what it was in 2007, but I think it was maybe 5% or so. And then household income is up and household debt is down, which is a really important. Anyway, so you can see that on many different, from many different perspectives, we're on better footing. So we can move on to the next slide. And so because of this, like, data that we just saw, 3 slides of data, Marcus and Millchap, with the help of Moody's, and, you know, every, you know, firm that's out there with their research, they're, you know, have all these baseline expectations as it relates to the virus and the economy. And I'm not going to go through this line by line, but I was thinking about modeling, and you know, what we really want to see is all the various models that are out there start to kind of align on their outcomes or their findings, because then we know that the, you know, kind of margin for error exception is smaller and smaller and smaller. But, you know, we're definitely seeing recession in Q1 and Q2. Some say Q3. We're seeing unemployment. You know, Marcus looks like you're saying 9% in Q2. We've seen 15%. And, you know, in terms of the epidemic issues, I won't touch on that because we see that all the time on the news. So anyway, so it's good to, like, take note of these data points and then see how they change on a day by day or every other day basis, because they will change.
Looks like they are projecting a recovery in Q3.
Yeah.
And going back in 2021.
Yeah.
This is their projection. Yeah, I think they're at minus 18.3. I think I've seen number like minus 25 from Morgan, or so everyone has their own projections.
Goldman, Goldman's at like 30, I thought.
Right. Oh yeah.
Around 35.
Yeah.
Mm-hmm.
But then like Goldman, JP Morgan, and the other Morgan, Chase Morgan. You know, it's like, I think Goldman was the highest,
Mm.
But they were kind of like the others were kind of averaging close in. And when I see that, I say, oh, that's good, because they're kind of arriving at the same conclusion. But, there's still a fair amount of variability here.
Yeah.
And also the other thing, and I love brokers, and I was a broker, it's just by sheer virtue of being a broker, you're optimistic. You have to make a livelihood. So
that's true. Gonna have to, have some filter for that.
Yeah. All right. Okay. So the next two slides, I'm going to blend my kind of talking points to both. So if you just glance forward one slide, we'll stay on this one. Yeah, either one. So, this deals with like, what is the state of, the capital markets and transactional environment as it stands right now? And then the other one was, as it kind of related more from an impact of health crisis. And, so there's a lot to say here, which I'm not going to do, but, Marcus is saying, the banks are still making loans. I think that that's far and few between. We know that the underwriting the banks are making, the reserves and interest are going, to 12 months to 18 months. I think generally people think the apartment market is going to be stable with a vacancy of around 3.5%, I think, for all classes, or class B. If it pops up to 4.5%, like, it's not really that big of a deal. Operationally, and this goes across all product types, but particularly office and apartment and office, is, there's a kind of a tenant by tenant kind of underwriting going on to see what the quality of the tenants are and doing workout deals with them. Let's see here. Let me see here. Let me take a note of this chat real quick. Oh, okay. Thought I had a note. Excuse me. Industrial is kind of similar to office, because a lot of the industrial is not just like an Amazon, the huge warehouse, but there's a lot of mom and pop shops. So they're, similar to office. And then multi-tenant retail, this is kind of interesting. So, and I haven't spent much time on retail, but the like standalone single tenant retail has done a lot better than multi-tenant retail, unless it's, kind of necessity based, like a grocery drug anchor. They see that as continuing on. Most of these industries they see as continuing on with some blips. But there is the larger question, and it didn't take coronavirus for this, to get being talked about, is the bigger question of the kind of larger retail centers that are becoming quickly obsolete. But I think the theme in terms of operation on all of these classes, and you hear it, throughout this presentation and all presentations, is like a lot of one-on-ones with tenants, whether it's, you're an apartment building owner or you own a 700,000 square foot high rise. So, and then close contact with your lenders, of course. All right.
Actually, sorry. Is there anything else before we switch to next topic?
No, I think that was a mouthful.
Thank you. No, you have good coverage for all these different asset class.
Yeah.
So some are definitely stronger than others. So
yeah, I mean, and I realized like we could do an entire hour on like these and a couple others. That would be
right.
Great.
So yeah, for all the audience who can maybe not stay for the whole thing, we're definitely going to do a part 2 of this in 2 weeks. So we'll have more info and come later. So I think I'm going to skip the self-storage asset class. It is a great asset class. Let me cover it just by a few sentences. And it's one of the strongest performing asset class. Even the REIT are basically all went down at the worst, about 20-25%. Only self-storage went down only maybe 10 on paper loss. But the tenants, are at least the owners of self-storage, are not seeing much of a rent collection issues. So we can talk more about that maybe the next time when we have this conversation, because we have a lot of great information to go through, especially for single family residentials and so forth. So I'm going to skip ahead.
We could even do an alternative assets one, and we can pick like another one.
Yeah, that'd be good. Yeah, we can talk about what other opportunities, what asset class would be doing well, even in today's environment.
Mm-hmm.
So, all right. Vijay, you want to talk about this?
Yeah, so this is a webinar by Michael Black. He's actually one of my favorite, it's really good. I listen to his podcast all the time, it's really good. So basically, they talked about tenant management. So again, have empathy. And interesting, they are very flexible with they recommend that being very flexible with tenants and be proactive at giving resources. So one panelist, he's giving them flyers with all the resources, how to contact the government, a list of local available jobs to provide other resources so that it's easy for tenants to get access to. And then there's a strategy of allowing security deposits to be used to pay rent, and then make sure that they're enrolled into security deposit insurance. And they actively use gift cards, $50 gift cards for paying on time or being proactive about their financial situation so you can work with them. So giving incentives so they can work with you. And they really want you to focus on lease renewal, which is critical because you want to decrease turnover costs. So do not raise rent, but focus on preventing move-outs, continue to work with your tenants. And they know that the lender environment is changing. Lenders are more linear and proactive at working with landlords. So, which was quite different back in 2008, where lenders were, I guess, a little bit more hostile, but now they're more open. So open to them. So be open to talking to them and see what they can offer. Next slide. Yeah, next slide. Yeah. So the market is changing. So sellers with adequate capital will hold on to the properties and they will weather the storm. I mean, this storm will last for a year, and as long as they have good financials, they can they'll be good after a year. But however, there are sellers who need to sell, and they're much more negotiable now. So Michael Black noted that the market has certainly changed like a buyer's market. So earnest money being non-refundable has kind of disappeared. The financial contingencies are acceptable. So, so the sellers are, very open to work with you. So the environment has certainly changed. So the panelists think that the opportunities lie in 6, 9, or 10 months from now. There'll be a lot more buying opportunities, but they'll advise that take time and don't rush into buying right now, even if a good deal comes. And the reason is, it's really hard to underwrite a deal right now because all the assumptions are unpredictable. So they're just warning the audience, just don't rush into buying a deal, even if it's really fantastic. I mean, if it's super fantastic, I guess that's an exception, but just check your emotions, look at the facts and check your emotions, and do pay attention to how the market is changing.
Yep, great information. Thanks.
Sure.
All right, so I'll cover this one. I'll skip a couple things, but this one, it's a panel discussion put together by a local Seattle investor, Tar Yaber. He invited Ken McElroy, who co-wrote a book with Rich Dad Poor Dad with Kawasaki, and then Kathy Flake and Jay Scott. They're both residential investor, and Jay does a lot of flipping, and now he's in more of a business entrepreneurship type of thing. I will skip a couple of slides, but I just want to talk about the creativity part, which I thought was really interesting, and I want to bring forward. I'm just gonna maybe read a quick quote because. There are lots of people listening and have the proud honor to say you have been through a downturn. But most importantly, in my opinion, it's the time for creativity. Turnkey property didn't exist, and brand new home wasn't a thing. This is back in 2008. So we have to figure out foreclosure and fix them up and create a turnkey. There might be something new that is created. So I thought this quote was important because there are always going to be a new business or a new different product that's going to be created in each of these downturn. And for Ken, we talked about a lot of capital is drying up. Banks are maybe not necessarily lending as it used to be. It was even worse in 2008 because it was a financial crisis. So what he did was he actually went up to Canada and raised $100 million because they can get a good hedge on the currency because you're seeing the US dollars were down and Canadians were up. So there's opportunities around the corner, even though there's risk in the current market. Also on strategy, I'll maybe skip over Ken's, but talk about this one in Jay Scott. So one of I thought was another interesting strategy he provided was he saw that there may be well, let's just talk about it. I was going to read it. In 2008, C-class property market rent didn't drop too much. In other places, actually went up. If you're underwriting 10% lower market rent and 10% lower occupancy, if the numbers still pencil out, buy the deal. So this is kind of how he does his underwriting, even in a bad situation or current situation right now. He's still focused on population growth, employment, wage growth. Something else, I'm buying businesses that own land. Pick up some great deal and SBA can finance the businesses so you can sell the business and hold the note on the business. So he's really just kind of having some out-of-the-box ideas, which I thought was pretty interesting. And
cool.
then
every downturn brings opportunities. That's testament to that.
Yeah, you just have to kind of uncover some of these opportunities.
Mm-hmm.
I think we were just talking about what Kathy says in this one was talking about because of all the capital injection, the $2.2 trillion in market, basically printing money. In some point, there might be a massive inflation. We don't know right now, but currently we might still be in a somewhat deflationary market. And she mentioned that Japan went through something like this. But oddly enough, if you borrow cheaply and finance them over the long haul, you're basically locking in with someone's money and you're making money on others people's money, basically saying that what you're paying for the borrowing cost or interest is fixed, but your wages or rent go up if you're in inflation. So that's a way to hedge inflation, I suppose, by investing in real estate. Yeah. I think I'm gonna just talk about this chart real quick. So this one is about if the viruses are, we found a vaccine or a cure for the virus. Are we gonna go back like in a V-shaped recovery? So I was listening to this hedge fund company. They're Wall Street guys. So there's a little different spin. And they're a little more bearish than some of the other experts and panelists. But basically, this is how they build their argument is before COVID. We can see on the left side of the screen is the Russell 2000 companies. And almost there are 36% of those companies already have a negative pre-tax income. So even though real estate fundamentally strong, maybe the corporate side isn't as good even before the COVID-19. And you may say this is only for small business, but even for businesses that are bigger than $10 billion in market cap, they're also at 27% of negative year-to-year earning per share. So, and we can see even in 2001, 2019, it peaked up all the way in the 40% range. So they're expecting that this is going to be in the 40 or 50 range. So they don't think that we're going to have the V-shaped recovery that a lot of us are hoping. So with that,
that's a good insight. Yeah.
Let me turn over to Boic to talk about this Redfin article.
Oh, thank you, Henry. So Redfin have an article talking about how this virus impact the market, the housing market. So majority is on the residential. Sorry, I talked too much today and kind of lost my voice. And I'm not going to share all view with you. If you want to read the article in detail, you can go to the article. I'm only want to share part of you, and also I will also add some personal experience in Washington here. So go to the next slide. So because of the stay-home order, much less buyers are willing to come out to check the house. In Washington, we have some new regulation. The agent can still take the buyer to see the house, but cannot be more than 2 people, in the house. So, and also some buyer, they're still too scary to come out to see the house. Because of this, some agent, depends on the location, of course, they put the house off market. That's what they call delisting. I actually today, let me see, now it's 1 hour ago, actually 1.5 hours ago, I have a conference call with a with a seller in Hong Kong. And then after the discussion, she want to put her $1.5 million house off market, wait till summer, because when the market become better, when after the virus outbreak, she want to put the house back to market again. So if you look at the screen, here's the listing percentage. Of course, depends on the location. Some of the location, for example, Seattle is 4%. Actually, on average, is 4%. But this 4% actually is more than double of the off-market percentage compared with last year. So the percentage is kind of considered big. And yeah, depends on location. And next slide. And next one is about the new listing. Of course, the people, the seller don't want to put their house on market too. I discussed with some agent, they already signed a listing agreement with some of the seller, but they want to keep the house right now, don't want to put on the market until after the virus outbreak. So because of that, the new listing percentage drop a lot, and also of course depends on location. In Seattle, we have only about 26, but some of the location, they can be more than half, I mean 60% or something, so it depends on location. Less and less new listing coming to the market. Yeah, so go to the next one. And this one, they're talking about the price. So the medium list price, they said that in the whole country, they find out the medium listing price drop, a little bit. This one, actually, I should say that, for real estate, especially the residential property, it really depends on location. So from my personal experience, last month, we have some closing. Last month, the price was still crazy. So I have one agent, he lists the house here. The listing price, I think it's $845,000. And then in the beginning of last month, he got 11 offers. And then the final selling price, $971,000. So we closed the file end of last month. So totally depends on the location. And also, I have an agent put the house on market last Thursday. And then the first day, they only have 3 agents call for appointment. And then yesterday, I already received the purchase and sale agreement. I would say depends on the location and depends on the price range. For those price, for example, in Washington area, Seattle area, for those price less than $1 million, if the location is good, the price will not be affected that much. But if the location is not that good, or just so-so, the price more than $1 million, they may need to consider put off market. Yeah. So.
Right. Yeah, as we see listing and coming down, there's probably even a bigger shortage of housing, especially in the affordable range. So I can understand that.
Okay, go to the next slide. And also this one talking about pending. Pending house sales on average in the whole country is less 42%. And go to the next slide too. Yeah. So and also of course depends on location. In Seattle area, the pending is less 28%, and some of the area in the country it can be 45, 57%, or Dallas 66%. So here's that's those slides from Redfin. And next slide, I'm going to share with you more on the local market in King County. You can use as a reference on the residential and condo. So on this slide, you see 2 lines. The blue color is the inventory. You can a new inventory, and then the red color is the pending. So if you look at the chart here, let's look at the 2018. In the first few months, you can see that the pending sales is higher than the inventory, because that means the demand is more than the inventory. So that's why on 2018, in the first few months, the price was crazy. So a lot of bidding. So, and then after May, when the inventory keep increasing, but the demand did not increase, that means have more inventory. Because of that, the price dropped a lot or slowed down a lot on 2018. And last year, 2019, you see most of the time, I mean, actually all the time in the whole year, the inventory is more than the pending, the demand. So last year, the price was okay, was not crazy. And look at this year, in the beginning 2 months or 2.5 months, you can see the record that the demand is higher than the inventory. So that's why in the first few months, the market here in Washington, in Kane County, the market was crazy. So, and I checked the most current information yesterday in Kane County. I think the active inventory is around 2,800 something. And then the pending in the last 30 days is only 1,700 something. So because of this, the inventory is more than the demand. That's why the price will be more, I mean, will be soft. That means less people are willing to bid on the property. So let's see what the market will going on later this year. So the chart at least can give you some idea what's the residential house and and condo in King County. Yeah. So that's it for me.
That's great information. Okay. So I want to bring this one, which is the metros with the most employment risk, and those the jobs that are employment. Those are at risk are basically in the hotel industry, retail, mining, logging, and constructions. So basically, you already found all the cities, at least ranked them by the most at risk. And you can see that Vegas, which is the hotel, Orlando, Disney are being closed, right? Florida, tourism. So a lot of those cities are being hit the most. But even cities that are more diverse, like maybe New York or some other cities, just because of the sheer size of the population and the number of businesses that are being closed, so basically every cities are taking a hit, but the most happens with these cities on the left. Also, one thing that was interesting when on the top 15 most affected, even areas that has been having great strong population growth and job growth in the Southwest and Southeast, cities like Austin and Charlotte are still on the top 15. So yeah, basically no cities are spared, even though the hottest cities. And this chart, just kind of for those who are investing in apartments, we have been waiting for what is rent collection for April looks like compared to March. And we just had this data released by Newmark. Just saw it on Facebook literally 30 minutes ago before this webinar. So I just want to bring this up to show everybody. And it does look like, just agreeing to what Jay said earlier, how the Class A apartments are doing better than B and C and affordable. So we actually have number that they're showing that right now. So with that, we'll give to Yan to talk about the COVID assistance programs.
Hi, everyone. I will just quickly highlight some resource. Depends on your role. So if you are like a small business or self-employer, then the first thing that you go to is SBA. You can apply for disaster loan assistance, the 10K. And the good news is you don't need to pay. So that's why it's highlighted as number one. Second thing, if you are self-employed or you pay somebody, then you can apply for a PPP program, which I think James also mentioned. It's possible that you may not need to pay. You need to find out the information. I think probably we have a slide that give out all the links.
Yeah.
And then if you have a mortgage, as I just mentioned, that you can call your lender and ask for forbearance. And then I think the requirement is just to prove how your income, either the rent or your your W-2 may be affected by COVID-19. As long as you can prove that, you can apply for up to 6 months defer the mortgage. And I think that they offer 3 options how you can repay. Either, let's say they approve for 6 months, then at the end of 6 months, you can pay like a 6 months mortgage in one time. That's one option. Second option will be at the end of 6 months, you, for example, you say, okay, I will pay in the next 3 months, in addition to what's the schedule mortgage. Another one will be, I totally want to reschedule my loan. So, and then you will sign with your lender a new one. So then you will just use that terms going forward. So those are the three options you will have. And then just a reminder, if you are a landlord, you might also be facing like defer rent from your tenant. So I think the solution will be similar to what you get from your lender. So you can also, for example, if they really cannot pay and then they can prove to you, then maybe negotiate with them, maybe delay, or maybe you give them some discount, or maybe use their deposit as part of the rent for short term. Yeah, so right now is the time to show your sympathy to them and also work with them some creative solution. But one thing you cannot do as a landlord during this lockdown period is that you cannot evict them. But you can still so that will affect their credit score for sure, although you cannot evict them. So you want to give them some incentive. You also want to warn them, don't take advantage of you. Right, so other benefits include you will get the 1,200 benefit from IRS if your household income is lower than 150,000 or your personal income is 75,000. And then I think they also will give you 4 months the unemployment aid. And also, if you owe government tax now, you don't have to pay it in April. You can pay it in July. That's also a good news. That's all.
And we have references, links to these different programs, and we can send the PDF file on this presentation later with the recording. And also just upcoming webinars. We're getting close to the end of the webinar today, but I just want to recommend a couple webinars that are coming up that go really in depth into the COVID assistance program. It will take an hour long at least to go through some of those. So if you're a business owner or you're helping your tenants out, definitely recommend going to their website and signing up for these program. And Neil and Anna is hosting, I think, a real estate broker and a lender to talk about what's acquisition landscape look like in the near future terms, or what's happening right now as people are coming to a closing table. One more also, this is actually directly from the SBA director, talk about the program. I know SBA is in charge of giving lots of billions of loans, which is probably 10 to 20x what they normally do. So they're definitely under stress and have pressure to give out all these money. So it'll be interesting to hear what he has to say and what the timeline is for people who actually apply for the SBA loan to get a check. So this is some of these webinars, and we also have references to all the presentations and all the articles that we talked about today. Feel free to go back and listen. And so as far as kind of promoting a next event, we're going to do another one of this webinars and news roundup meetup then April 21st. It's going to be Tuesday at the same time, and we'll see what other great topics will come up, and we'll update everyone later as we get closer. Also, the following Tuesday, next Tuesday, April 14th, we have a few of us who are on this co-investing meetup group where we take a project and we analyze the deal, we underwrite it, and we share what our insights as to whether this seems like a good investment or a bad investment in light of what's actually happening in the current climate. So there's a link to register for that webinar as well. With that, I think we can go to talk about, let me share all the contact information if you would like to reach out to any of us. And we're in your local area. I know we had to practice social distancing, but feel free to email us and we can chat definitely. Do we have any question we like to cover on any Q&As as well?
I think there were some questions regarding how long the housing market's going to see an impact. Maybe Bowick is someone who can add some light onto that.
So how long the real estate market, I mean the residential, will be affected by this?
Yeah.
It's a good question, and it's hard to answer. So
Absolutely, yeah.
Let's use two formats to think about that. Think about the short term and long term. For short term right now, because the buyer, potential buyer, they are scary about the virus, so they don't want to come out to buy. So and also they may, their income may be affected by the stay-home order. So that's why in short term, the buying power, it will not be that strong, although the interest rate is low. So because of that, I would say in coming few months or the coming one quarter, the house market will not be strong. But talking about long term, there's a big uncertainty. Long term, of course, the those buyer, they will go back to work. Most of them will go back to work. They don't need to be stay home. They are not scary about the virus anymore. But for long term, all we concern is about the economy. If the market, according to a lot of prediction, the economy will not be that good. And then if the economy is not that good, that means the housing market will be affected. And then the house price may drop. Some people actually predict that 15 to 20%. So because of that, some buyer 2 months later, when they are okay to come out to buy, but they may think about, actually, I have some discussion with some agent and they are the potential buyer too. They said that some of them, they think the market will slow down, the price will drop. So they will hold their buying decision, will wait for few more months to see how's the market, and they want to keep the money to buy something cheap. So that's why the short term and long term theory, according to both of the assumption I talked before, most people believe that the house market, the residential house market, will not recover at least before the end of this year. So if the economy is not that bad near the year, then the people, their income is okay, their buying power is okay, they will come up to buy more. But most people believe that before near the end of this year, the market may not be that strong. So
I see. For the rest of the year, it depends on investor sentiment, and also household sentiment of how comfortable they are in their jobs and if they can afford the real estate. Thanks for that answer, Bowick.
Hey, Bowick, this is Peter. Actually, I didn't know how to, I was so excited by your presentation. I wanted to ask you a question. So that was my question. But it's interesting how with single family homes where the occupier is the owner, not only is the economy a big driver, but the kind of, if you're moving, buying a bigger home or a different home, or maybe you're a renter going to become a buyer, it's both, economic as well as emotional. And, maybe it's 50-50 in terms of each category. But that's a great explanation.
Yeah, it might be very location specific too. I heard from the webinar, areas close to medical facilities are hiring very right now, and they may not be as affected as other places. So, yeah. Also, anyone wants to actually also allowed to. I mean, you can also directly speak if you press the raise hand button in your in Zoom. Um, is there any other question, Vic?
I think there was another question about the impact to the economy in general, job losses and all that. It's really too soon to say how many jobs might be lost. We see that some firms like Goldman Sachs predict about 15 to 20% unemployment. Whether that's going to turn out to be true, only time will tell. But it's going to be a sharp decline in both jobs and GDP. But the consensus estimates that I've been listening to and reading about, they project sort of a later recovery in the later part of the year, perhaps even as late as 2021. So that's something that I've been reading.
Yeah, I mean, some of the businesses that are temporarily closing might actually not come back after this is over. Of course, it all depends. They might be paying the rents, but I know there's some business owners that are currently, have to let everyone go. And it's sometimes people talk about a pent up demand for services, but you cannot have maybe 3 dinners or 5 dinners. You cannot make up for the lost revenue, so it'll be maybe difficult for some of the smaller businesses, and that in turn affects consumptions because U.S. economy is built on consumption. So if we have less consumption and less consumer confidence, I think that might impact the economy a little bit deeper than we will hope.
Right, consumer confidence drives a big part of the economy. There was another question from an anonymous attendee. Where are mortgage rates for investment properties headed? Will the slashed Fed rates translate to lower consumer mortgage rates?
Yeah, I think so. It should be changed. I mean, right now, I think it's not so much about the interest rate. Actually, from what I'm hearing, at least from the commercial space, actually has gone up because the uncertainty of the period. Banks are basically holding on, wanting to make sure that your property is going to perform. And so there's a risk premium that they're putting in right now. So I think banks are more hesitating to lend. What is in the single family or residential space? Has anyone recently done a refi or had any information to share?
I haven't to refi recently, so I have first-hand experience. So according to my lender, they said that the lowest point in March was on between 6 and 9. So at that time it was really low. And after that, although Fed cut the rates, the thing is, Fed cut the rate is like a primary market, but when you refi, it's actually on secondary market. So they like deviate from each other. The reason is because on the secondary market, the investors they are so scared they don't want to buy. So if they don't buy it, the bank, they cannot free up their money to lend it to you. That's why even after Fed cut the rate, on secondary market, you see that mortgage rate is actually going up. But recently, I think it's in late March that actually go down. And I guess it's because the stimulus package going up and then going out, and then people feel confident. So yeah, I think right now is a good time to reach out to your lender to see whether you can refi.
Right, and just to add on the commercial side as well, even though the interest rates for commercial properties are based off treasury bond yields, what's happening is, as Henry mentioned, there's some risk premium that most lenders are adding because they don't know what's going to happen in a month or two. However, you also have to realize that all these mortgages are securitized, meaning they get sold and they get packaged and sold off to investors. So those investors are demanding a much higher premium in the current scenario. So there could be a short-term increase in commercial lending rates, but there is some belief that those will start to taper down later in the year. But
All right.
lending restrictions, however, have increased significantly for commercial properties.
Yep. All right, I think we are at 7:30, so this is the end of. So thanks so much for all the audience that stayed of the call. Wow, we still have 36 people. So thank you for everybody and all the panelists. That's a great presentation. We'll do it again in 2 weeks. So thanks again, everyone. Appreciate it, everybody.
Thank you all.
Thank you. Good night.
Thank you.
Thank you, everybody.
All right.
Be safe.
Thank you, everyone.